Welcome to the Contrarian Investor Podcast. We give voice to those who challenge a prevailing sentiment in global financial markets. This podcast is for informational purposes only. Nothing on this podcast should be taken as investment advice. Guests were not compensated for their appearance, nor do they supply payment in order to appear. Individuals on this podcast may hold positions in the securities that are discussed. Listeners are urged to educate themselves and make their own decisions. This podcast episode may have ads and the occasional announcement. To listen without ads or announcements and take advantage of a host of other benefits, consider becoming a premium subscriber. Visit the website contrarian.supercast.tech. That's TECH for more information. Now, here's your host, Mr. Nathaniel E. Baker.
Here with Axel Merk of Merk Investments. Welcome back to the Contrarian Investor Podcast, Axel.
Great to be with you. It's about time, I said.
It really is, yes, and it's great to have you back. A lot has changed. A lot is going on. It's been a tumultuous month of April 2025. Front and center are tariffs. You have some views here that I would like you to discuss about how tariffs have upended the global order of things and changed global finance. Am I getting that right?
Just about. And I published a piece of whether the plumbing of the financial system is changing back in March, before Liberation Day, I might add. And it's important because you got to look at the world in terms of a framework and then test your theory against it. And by the way, I don't see my role as having a crystal ball that's always right. I see my role as providing food for thought so that the audience can test whether they have considered that the risks I'm describing just might be right. And it boils down to, well, let me give you a simple example. I'm sure everybody has heard the Trader Joe's story by now, that you have a Trader Joe's trade deficit. The thing that's not talked about there so much is the financial side of it. If you were to have a quote unquote trade balance with Trader Joe's gets less money. And now translate that to what's happening in the world. If we, through decree, executive order, force trade to be in balance, it does impact financial flows. And that has to be seen in the context of a world that's highly levered. It has to be seen notably in a world where the US has substantial deficits. And so one of the things people have noted is, oh my God, long-term yields are rising. Well, it's because, and I'm simplifying here, but because of these tariffs, to the extent that they're serious and not just short-term negotiating tactics. And by the way, my view on that is Trump has believed since the 80s that trade imbalance in good is bad. And therefore, my baseline is that he kind of likes the 10% baseline. Everything beyond that is negotiable. But even that, right, that will impact financial flows. And so that means deficits will need to be financed more domestically. And that provides certain incentives, inducements. You might get your deficit in order, maybe. DOGE does some of that, but we're not tackling entitlements. You might get higher rates. We clearly see that. You might get more pressure on the Federal Reserve, and we can talk about that because my views are not exactly the same as most that have talked about that. But there will ultimately, in my view, be more pressure on helping to finance the deficits. And kind of all of that, one of the reasons why gold has been reaching all-time highs because it's kind of the catch-all for many of these things. But it's that sort of framework, I think, in which we have to look at this. And of course, there's a lot of noise in that. I mentioned leverage. The extreme leverage, if that's the right word, has somewhat been taken down. And also people get used to a new world, right? And the market is very, very good at adjusting to things. And then we can pick out the different stakeholders, notably businesses versus governments, but I don't want to rant here for a few hours, give you a chance to ask some questions.
Yeah. No, this is all very interesting. So I'm just trying to think through it and what you mean by plumbing and the fact that, so are you saying that China or whoever's been buying the treasuries has helped finance the US trade deficit? right? And that they're going to stop doing that, and that the purchasers are going to have to come from the US. Is that right?
Well, it's a question of math, not politics.
Yeah.
And so the current account is a formula. And of course, it's not just goods, there's also services in that. But if you throw a wrench in global trade, it will affect financial flows. Now, just mathematically, right? And then we can give these different characters some flavor. And let's just talk about it, right? On the business side of things, businesses like to sell to American consumers, right? They'll figure out a way. Now, there's an argument, I happen to agree with that if there's uncertainty, people will be reluctant to invest. But keep in mind, before I talk about the other things, if you want to get trade into balance, you can use a stick approach, tariffs, or you can use carrots. And the Trump administration has signaled they do both. Indeed, they have done both. Treasury Secretary Bessent just said, "Oh, anybody who builds a factory will allow them to write off 100% of their investment, including the building." By the way, whether that's going to pass, another question. But that's the sort of attitude. Similarly, cutting red tape is really one of the biggest impediment. But on the other side of that, if you don't know what policy is going to be in 5 years, let alone in 2 months, you might be reluctant to invest. And by the way, if you think that the fiscal situation is unsustainable, why would you invest in a 20-year project? Because the government's incentives are not aligned with yours. They might get you through higher taxes, higher inflation, or other sort of expropriation. Now, the other thing that you mentioned, and this is mentioned often, is, well, what about China redirecting their investments? Clearly, if you're not a friend of the US, you have been, quote unquote, incentivized to rethink your asset allocation. Now, it is not in the Chinese interest to dump all the treasury holdings. That said, on the margin, future allocations will likely happen differently, and gold is but one of the beneficiaries in that. And the key difference between private enterprise and governments is that government really has a choice on a strategic move, whereas business is just, we are all selfish, profit maximizing creatures, so we'll try to find a way to get around these rules. I mean, that's kind of why all the production has shifted to Mexico. By the way, that's one of the big problems with tariffs, that people will look for exceptions. And one of the reasons I don't like tariffs is for reasons that are not typically discussed. I think tariffs built the swamp because everybody asked for an exemption. They are good for business, big business, and bad for small business, because we've heard Apple, and I'm not making a judgment call on them, but they get exemptions, but small business not at the negotiating table, consumers aren't at the negotiating table. But in any case, what is going to happen, and if you just think about it, any government in the world is going to say, we're not going to be in that situation again. We don't want to be there. Now, of course, it's easier said than done because the US is the greatest market to sell to, but the argument against that's often mentioned is there is no alternative. And I agree with that, except that's not the right answer, because there doesn't have to be an alternative. The alternative is, in the absence of another reserve currency, is a fragmentation, right? It's a reduction. And it's one of my big themes is that the cost of doing business is going up. And if I may, can I just take a step back, because there's one thing I think I should have mentioned as well that I think many people intuitively get, but why this is all so relevant. The US can be thought of as a large bank or hedge fund, if you will. People borrow in US dollars to finance projects for higher returns abroad. It's really a levered play. It works great for Americans. It also works great for foreigners borrowing in US dollars. It's one of the reasons why historically in a risk-off environment, you have a surge in the dollar, because people quote unquote de-lever, because this bank play is really a short on the dollar, and then it goes back. But when you, again, throw a wrench in the global system, you're disrupting that. And it's that disruption that threatens the exorbitant privilege that the US has. Because if that engine is slowed down or brought to a halt, Well, it's not like the European Union or the Chinese are going to take the place. No, you're going to have a fragmentation. You're going to have just less trade. You're going to fall into old habits, and so that doesn't mean you can't rebuild the U.S. industrial strength and whatever. But this ability, Charles de Gaulle, the former French was the president or prime minister. He said it right. The post Bretton Woods era is a license for Americans to print money, and that license is under threat.
Right. Okay. So let me ask you this: are tariffs inflationary or deflationary for U.S. consumers?
They're stagflationary.
Okay.
Tariffs are a supply shock. Right, it's
Right.
very simple math. In the pandemic, we learned what a supply shock is. And from a U.S. point of view, let's talk about Europe here in a second. But it's clearly a supply shock, and it's one of the reasons why the Federal Reserve is in such a tough spot, because you cannot react to a supply shock by lowering rates, because eventually you might rebuild the production, but not in the short term. You cannot replace that by kind of if you stimulate demand when you have less supply, you're going to get higher prices.
Yeah.
It's a simple economic model. The stunning thing is that Lagarde at the ECB she takes the opposite side of that, and because they're on the outside of the tariffs, saying, oh, it's a demand shock, and we got to lower rates. She is completely ignoring, though, that there may be punitive counter tariffs and whatnot. So the cognitive bias of these policymakers plays into it. And the broader point, though, to make is the reason I mentioned the word stagflation. Once you're hit with a supply shock, the economically sound reaction is often not the politically sound one. So imagine Trump going out, we have a supply shock, so why shouldn't we have a little higher rates for a little longer? Wouldn't that be great? That's political suicide. So he says the exact opposite. And it is one of the reasons why stagflationary periods last often for a decade, because there is this tension in doing the quote unquote right thing. Also, when you're in a tough spot, populism is on the rise, and the populist policy is not always the economically sound one. And I'm not questioning whether it isn't a good idea to rebuild the industrial base in the US, but we are in an environment where we have highly unstable dynamics. One of the things that I agree with, one of the few things I agree with former Fed Chair Bernanke, he said, once you've had high inflation, you don't just go back down. It becomes a volatile period. It is one of the reasons why it's so difficult to react to this thing properly, and especially on the political side. It's difficult enough on the monetary side.
Yeah. You said it before that the U.S. is the biggest export market for just about anybody. And what do you make of the theory then that because of that, these companies, any company on earth is under enormous pressure to make a deal get lower tariffs with the U.S. Therefore, will put pressure on its government to make a deal with the U.S. on tariffs, and that they basically have no choice but to do that. Like you said, nobody's going to replace the U.S. consumer, at least not in the near term or even medium term, right?
Well, that's all correct, right? And in an ideal world, you have. You mentioned tariffs, inflation, what do they cause? And in an ideal world, you raise the price level once and you live happily ever after. Except that is not what is happening, right? And it is not what's happening because you're impacting the financial flows. I think it's that part of the equation that has a huge impact that people underestimate. It changes how money flows around the world. It changes how people operate. Now, clearly, there's a huge incentive to get this to somehow work. And in Trump's ideal world, right, the trading of goods gets balanced, and it's of course aspirational, right? It's aspirational. You work in that direction, and the one thing to keep in mind, especially when you're in an unstable environment, and especially with Trump, given his history, it's not a straight line, right? Trump takes like 2 steps forward, 1 backward, 1 sideways, and so it's part of the reason I said in the introduction. my thoughts here are not a crystal ball, it's just food for thought, because go back to the financial crisis in 2008, right? I was one that, quote unquote, predicted the financial crisis. I had no clue about every move that would happen. Even if you predicted the financial crisis, was no assurance you make money along the way, because the rules of the games change. And that's why I stick to high level themes like the cost of doing business is going up. And we haven't even talked about kind of global geopolitical threats, which also raises the quote unquote cost of doing business. The US is in retreat globally from being the global policeman, which means shipping things on the high seas becomes more costly, so to speak. Now, that is also an incentive to do more production locally, or nearshoring in any way. But all of that is a higher cost of doing business. It's a less efficient way of doing business. And it may be politically the right thing to do, that we don't have the Chinese produce everything, but it is a less efficient way to grow an economy. And if that is the political choice, it has real implications for investors and also for politics, of course.
Yeah, exactly. And how is this not going to end badly, for anybody who's looking to put risk, to buy risk?
To answer your question specifically is because there's no end. But I agree on the bad part. The one big mistake that a lot of people, especially in the doomsday community, make, they talk about the end game. They talk about this. There is no end game. There is always the next phase. Look at Latin American economies, right? Or look at any economy that was thriving and then fell into disarray. And I'm not suggesting that the US is necessarily going to go down that same path. But there's always a tomorrow. And one example I like to bring up is in the 50s, there was one breadwinner in the home, right? And nowadays, if you were to suggest that your spouse should be in the kitchen, you're going to get slapped in the face, right? Society adjusts. Or we're terrible of saving for old age. Now you see folks 65 plus, they are proud to be still working, right? So we adjust mentally to a changing environment. And I sometimes argue that kind of the sort of drivers that led to the financial crisis, the world that we were in, is we got the Chinese to join the world market. That fostered a global overproduction, which means high commodity prices. US companies were squeezed with that supply coming in. They tried to lower fixed costs. And by the way, then there were government policies after 9/11 to quote unquote keep America rolling. And so in order to compete, American companies outsourced production overseas, which means we lost jobs. Well, the folks who lost jobs because they only have a few weeks of savings, they got any job they could get, or they started a small businesses. Most failed. And the beauty about the US society is that we can adjust so quickly, but people felt something is wrong. And so they got angry. And they, from their perception, big finance was bailed out in 2008 and whatnot. And so then they start to vote more populist politicians. And we get the rise of folks like Trump in the US and other populist politicians. So, and then at the same time, we get into arguments whether Trump does the right thing or the wrong thing. And we neglect to think about, we have all of this because we messed up 20 years ago in some policies, right? And so it's and it unleashes an unstable dynamics. I published a book in 2009 in how to thrive in a world of debt and consumption, describing this instability. And by the way, I'm not trying to pitch that book. The short summary is spend less than you make and you'll be fine. And so that's I wrote that in 250 pages. But the point here is that instability is on the rise. And the one thing to just talk about, quote unquote, ending badly is, one of my views is that the relatively peaceful period we've had since World War II is coming to an end, or has come to an end. And what we see in Ukraine and Israel or Gaza are just symptoms of a new era. We will see this defragmentation isn't just on the financial side, it's also political side. And as critical or in love as people are with Trump, the beauty about the US system is that it's flexible. I'm far more concerned about other countries, Europe in particular, that have very rigid systems, because a flexible system adjusts, a rigid system breaks. And so the disruptive forces that we have, and we touched on some of them, there are many more, they will induce change. And if you cannot change, you're toast. And so we may love or hate what's happening right now, depending on how we're wired politically, but we'll get through this. Whereas I'm actually in now, of course, if the Europeans throwing out over $1 trillion on spending on defense and whatever it is, they'll live another day, right? The policymakers are good can kickers, but the risks things will break. They may break in countries we don't really care about because they're not represented in the S&P 500. But I do think we should be keenly aware that we have highly disruptive forces underway.
Yeah. And ultimately, again, we're talking about a world here where where the cost of basic goods and services, not to mention luxury items, cost a lot more, right, for the average American. And with the US being the main driver of consumption, I mean, how is that going to be at all positive?
Well, let's before we went on the call, I said I can even disagree with myself. Let me just make a counter argument to that. I have a new best buddy called ChatGPT. For $25 a month, I get on a daily basis value worth thousands of dollars. I get a non-disclosure agreement from somebody. I'm on a business. I run investment business. We manage a little over $2 billion, and so I get a non-disclosure agreement on some item. I throw it into ChatGPT and say, point out anything that's different from a non-standard NDA. And I get a little summary, right? Or anything, right? Now, it doesn't mean it's always correct or whatever it is, but we are developing tools to dramatically boost our efficiency, right? And so while we are stuck on this doomsday scenario, everything is going to be horrible, let's not forget the creativity of innovation and business. And by the way, to just throw in another tagline, in order to have innovation, you need to have free speech. Free speech is the essential ingredient because you need to be disruptive in order to innovate. And there the Europeans, Germany just forming a new government, and part of the coalition agreement is to make sure only proper facts are come out, and it might be punishable if you, J.D. Vance was talking about that in Europe. That's a huge concern. But yes, there are concerns, but there are also solutions. By the way, one way to frame this, and I didn't come up with this the first time, Neil Ferguson, that some of your viewers might know, he's an economic historian. He wrote a book, I think it's called The Square and the Tower, or The Tower and the Square. And he talks about this concept of rigid societies break, and he calls them network societies. They do well. But the reason I mentioned this context is this was before the current culture wars and all that. But he said the era that we live in, and he was referring to kind of early days of Facebook, is similar to the invention of the printing press. When the printing press was invented, it made news available to the masses. And it was so disruptive that governments in Europe toppled. It threw Europe into the dark ages. And it's that sort of equivalence that we have today, that governments don't know how to deal with this fact that suddenly everybody has access to information. We have, of course, Wikipedia and everything in our pocket, but that's also going to get ever more powerful with analytical tools like ChatGPT and so forth. That means the traditional guardians of truth, the traditions guardians of power, are getting disrupted. And that has major implications. And again, some societies can absorb that, others cannot. But it's part of the reason why we have this tremendous friction there. And I'm not trying to side with one side or the other on any one of these culture wars. I'm just pointing out that these tensions are going to boil over in some areas. But there are also, of course, tremendous opportunities that come with that. And so I'm not just saying, hey, this disruption is all bad and then we're all going to hell. That's why I'm trying to stay high level and say the cost of business is going up.
Sick of me yet? Become a premium subscriber and avoid all ads or interruptions. Other benefits as well. Visit contrarian.supercast.tech for more information.
You mentioned Europe and Europe being, one of the potential losers here of all this disruption. But then a lot of these things that you're talking about made me think of China. I mean, you've got here a top-down, centrally controlled export market, right? And you can say that you need freedom to innovate. Well, China's done some innovation. The DeepSeek that thing, they've done some innovation, all but driven from the top down. What do you make of that and the fact that maybe that could be a model, this kind of neo-authoritarian, quasi-capitalist, beast?
Well, the liberal democracy is under threat. I think that is very clear. And I'm just reading a book. If I can look this up while we talk, it's a scary read. It talks about kind of the motivation of The Light That Failed is the book, and it talks about how Eastern Europeans, before the wall fell, before they were integrated to the West, they had this ideal of democracy, and reality could never live up to that. And then the reality came, and not only did reality come, that was actually pretty ugly, but it changed. And a lot of these folks in Eastern Europe were very conservative, and suddenly there was all kinds of stuff that this is, what the hell is going on? And talking about how the mindset is changing and how today's populists are building on that and attacking the kind of the liberal democracy from within. And so I would agree that is under threat. I'm not saying in which country it is more than others. Again, I happen to think the US is a system that's far more flexible. But yes, there are different things. Now, just about China, 20 years ago, there was a joke going around that the reason why capitalism works in China is that they don't enforce their stuff too well, right? The Soviet Union was able to enforce their communist ideology and nothing worked. In China, you get away with stuff, and the joke was somehow that they can build McDonald's and do all kinds of stuff. I'm not going to. There's some dirty jokes. So let me pause there. Sorry, I'm getting distracted. But yes, the Chinese system is, of course, the danger is that if you disrupt China too much, that regime might topple. Now, conversely, of course, a regime that's under threat might engage in aggression in order to assert control. Mm-hmm. And so there, of course, and I don't have the crystal ball of whether they will or will not, and I do think that the administration in the US is very keenly aware of this. But there are certainly numerous kind of risks out there that are elevated. I'm far more actually concerned about the risk we don't pay as much attention to, the unknown. All driverless coming out. I think a country like Turkey we have to pay close attention to, and other things. I don't know the details how this will play out, but I do think that the Wall Street Journal just had a story that Russia is building military bases inland from the border to Finland, with the idea that once the Ukrainian war is over, they allocate tens of thousands of troops there. So there's that sort of stuff, that there will be more tension. And if it's only tension, that's just fine, right? And the US, being isolated just geographically, is in a far better position than many, many other countries around the world.
Unless we attack Canada. But again, I mean, China, you would think is the biggest risk of what you talk about, which is, I mean, again, trade and they need to export more than anybody. And wouldn't that be a bigger risk in Europe?
Oh, it's a tremendous risk, and we know how they react to everything. And one of the things I have, as I talk to you, I have my Bloomberg terminal, and one of the things I'm looking at on a daily basis is there are some Chinese gold ETFs, and to see whether the Chinese are buying more gold. Because one of the things that's in the news, that how the Chinese might react to these trade wars, is by substantially devaluating their currency. So if you are Chinese, well, why don't you buy more gold? I mean, other things as well. One of the reasons, by the way, that Chinese always pour money into one or two investments is because they don't have the same open free markets. And so they will do whatever they can, and gold, it used to be real estate, right? But it's one of those, or some other investment scheme. And so the question is, if the Chinese masses get quote unquote triggered, Will they start a revolution? Will they buy gold? Will they do this or that? And we can guess. My own view is that I look in the world in terms of probabilities. And so I said, okay, I might judge these probabilities a little higher than the average might, and therefore I'll allocate some capital in that direction because I think the market will catch up with me. I don't claim to be right, but I'm doing my own risk assessment and think the market might be underpricing those risks. That doesn't mean that risk will realize, and at the risk of confusing your audience even further, because I've thrown a lot at them, the one thing, because you just on the end game thing again that you mentioned earlier, people make the mistake to think that the market prices in what will happen in the future. No, the market prices in what might happen in the future. And then when you're in the future, it doesn't price in the present. It will price in yet again what might happen in the future then. And so and it's a mouthful, but I do think it's important to recall that in a world of tremendous instability. Now, to just close the loop on that, the market gets the hang of it, right? Similarly, when there's a terrorist attack somewhere, the markets move, but the next one, the market reacts much less to because they get used to it or might be less levered. And so similarly, on quote unquote Liberation Day, the market reaction was rather severe. And since then, there have been some comments coming out of the administration and the markets barely moved. It doesn't mean necessarily the market doesn't take those words seriously anymore, but it's starting to get used to how to price those sort of things. Now, clearly, the reason we have the volatility is because different scenarios are possible. And I think one needs to take that with humility, that no one can claim, and I'm certainly one of them, that I'm right in what will happen in the future. And that's why I also try to say, volatility is going to be higher, the cost of doing business is going to be higher, this is going to be expensive, it's going to be expensive to get many of these things done.
Yeah, but you like gold and gold miners, right? Can you talk about that?
Yeah, well, we've been, in 2005, I started my business in 94, actually, took it to the US in 2001, started the first public product in 2005, and it always had some gold in it, but the market kind of pushed us ever more into that. It's an area we were able to differentiate. And I sometimes call gold as the purest indicator of the mania of our policymakers. And that's not for or against any one politician. But because gold has fairly little industrial use and is ultimately competing with cash, it's just has a very, and it's a comparatively small market compared to many other markets out there. And that's sometimes you have these exacerbated moves, but gold should be correlated to long-term real interest rates. And I say should, and what I mean with that in theory, markets are discounting mechanism. If in the long run cash retains its purchasing power, why hold gold? Whereas if in the long run cash doesn't retain its purchasing power, you might want to hold something that does. And of course, traditional equities might serve that purpose. Gold is just one of these indicators that's pure and has few other disruptors. And the one thing about gold is that gold is this thing, people say, oh, it has zero correlation to equities. Well, it has a correlation that morphs in and out and is zero over time. With regard to long-term real interest rates, it had been, I'm talking about the past, more steady. It broke down when the US started to weaponize the dollar. Now, whether that's correlation or causation remains to be seen, but the storyline fits that started to, quote unquote, incentivize the Chinese and others to reallocate their reserves. And so that has broken down. And of course, gold reacted strongly to the imposition of tariffs for all I believe, the reasons that we have mentioned. The one enemy that gold has is price, maybe, because at some point a trade is too much of a good thing. I don't think we're there. And the reason I don't think we're there is we have not seen a retail frenzy into gold. You would see a retail frenzy into gold if you were to see premiums on coins shoot up and things like that. This has been an orderly move into gold. It has not been, I haven't seen anything extreme. Now, clearly volatility has been high, but in my assessment, it hasn't been extreme. On the gold mining side, a lot of people have been burned investing in gold miners, and for all the right reasons, they've been burned. These major gold miners in the previous bull market, they overinvested. Then they were told to get their act together, which they did. But now they're depleting their reserves. They have less leverage to the price of gold. They're now playing catch up by investing in these huge projects. Barrick Gold, or Barrick now, I'm not giving an investment recommendation on them. They just changed their name, dropping gold out of the name because there isn't enough gold in the ground to keep up 5 million ounces a year in production. And so they're moving more towards copper and other huge projects, more difficult to execute on time and on budget. What we do is we actually go at the other extreme of it. We help finance junior mining companies. We want to have kind of catalysts in there that go beyond the price of gold and whatnot, and to help institutionalize these. We think disproportionate gains can be made. It's a highly speculative area, so I'm not encouraging people to necessarily go into that. They need to know what they're doing, but I think there are tremendous opportunities there. The basic gist of it is, of course, that gold miners are levered play on the price of gold. Historically, what happens is when money moves into gold, it first goes into the majors, and then the miners catch up with some, and then some. There's, of course, a lot of cross currents there, but I'm on the record of being a significant insider buyer in the gold mining industry, in a gold mining fund. And so I may have a bias, but I'm certainly putting my money where my mouth is. That said, I mentioned this mostly to kind of illustrate the dynamics, that gold tends to do well when everything else does poorly. 2008 was a good year for us, right? This year has been shaping us to be a good year for us. So if you want a recession indicator, how well our business does is often better than some of the other things you see out there.
Do you think we end up with a recession in the US?
Well, keep in mind that a recession in the US is decided by a committee. In most other countries, it's 2 quarters of falling GDP, and as we're talking, we just have a real GDP print that's negative. Keep in mind that the economic numbers are going to be tremendously distorted in the coming months because of the surge of imports. And so I would take any economic number that comes out with a significant grain of salt. Now, that said, if consumers believe prices will go higher, if businesses are reluctant to invest, and there's substantial anecdotal evidence in that, that if you're importing stuff, nobody wants to take that risk that tomorrow the price will be different. And so fewer transactions will take place in the short term. Whether that will amount to a definition of a recession based on what's announced, I do not know. By the way, we should point out, why do we care about a recession? The reason we, aside from us losing a job, the reason we care about the recession, that historically markets perform poorly in a recession, especially in a more significant recession. If it's a light recession, market being a discounting mechanism, it may not matter. A more severe recession, the Federal Reserve tends to cut rates more strongly, and it's, by the way, one of the reasons why gold is doing well. And again, it matters more, by the way, whether there will be whether there's a threat of a recession. Like this recession that hasn't come has been good for the price of gold. It doesn't really matter that it hasn't come yet. And when we're in the recession, people will look forward again. Can we get a recession? Of course, but don't underestimate the ability of the Trump administration to throw out some carrots. The most notable one is kind of special depreciation to encourage investments. There's all kinds of levers you can pull in the short term. The other thing, to just throw out a word of caution, I mentioned Bernanke, where I agree with him. There's an area I disagree with him. Bernanke is a firm fan of micromanagement of the economy, and he has put that seed into the head of the subsequent central bankers. I think everybody recalls the bailout of the banking system that mismanaged the interest rate risk. Of course, we don't have a recession if we bail out the banks from withdrawing. And so the next recession might just look a little bit different in the markets because of the micromanagement that central banks, and notably the Fed, do these days.
Mhm. Besides gold, are there any other obvious winners for you? Maybe could it be a geographic area? Could it be like an asset class or something like that?
Well, I mean, first of all, even in gold, there's going to be volatility. Um, you can, of course, you can bet on deregulation, right?
Mm,
Because there will be a significant drive towards deregulation. Um, in post 2000, by the way, what happened in 2000, everybody got ready for quote unquote Y2K. For the youngsters on this call, this was about the calendar moving from 99 to 0, and everybody freaking out that that might crash computer systems. And what that meant for big business, most computers didn't, but what it meant for big business, that everybody needed to buy the latest and greatest computer, um, which had the reaction then that once 2000 hit, you didn't need to invest in anything. Fast forward to today, everybody and their dog is importing stuff to be ready, which means in the coming months, we don't need to buy anything anymore, or at least the importers don't need to import anything anymore because they've bought everything already. And so, but on the deregulation side, cutting red tape, cutting regulation, the industries where that happens. Sorry to mention mining again, but there's an executive order on strategic minerals. Gold in that executive order was elevated to a strategic minerals, noteworthy. Besant, by the way, says he's a gold bug. Cutting the permitting process is tremendous value. So in any industry where that can happen, now I don't think that the FDA is not necessarily going to cut down the approval process too dramatically on new medication, but any industry where that can happen. The other thing is, of course, back to 2000, small cap value did reasonably well, right? I'm not giving an investment recommendation, but things that have been neglected. We haven't talked about the context, right? The Max 7 are kind of pricey by many metrics. And so a quote unquote normalization, or more broadly speaking, I think if you look at global markets, it's quite likely, in my view, that other parts of the world will outperform. If you just, I mentioned Europe spending $1 trillion, and I'm not being modest here. The Germany is going to spend over 500 billion on defense. In order to get that done, they needed to promise their new coalition partner to also spend on infrastructure. The EU wants to spend on defense. Other European countries are waking up to the fact that that the US might not save the butt as much anymore. They don't have the infrastructure to ramp up military spending that much. So a lot of the money will be wasted, but that doesn't mean they won't spend it. Draghi, the former ECB chief, he was praised for coming out with a paper about how regulation will be cut. Well, a big part of that report was how the EU should spend 5% of Eurozone GDP, not of increase of the budget, of Eurozone GDP on innovation. Those are, and the idea is, by the way, that the EU wants to create a debt market that's backed by all of Europe, not just national countries. It's a big thing over there. But in any case, that can boost asset prices. And I'm just here, as I'm talking here, in the European markets are up quite substantially here, right? I mean, in US dollars, the DAX is up 23% year to date. The FTSE 24.7% as we're talking here on April 30th. And so part of that is the dollar has weakened, and so in dollar terms, those markets are higher. But it is partially because these guys are pumping a lot of money into the economy. And I mean, with the caveat, I told you I'm not that optimistic on Europe because of the rigid structures, but it doesn't mean that the markets can't do well for a while.
Yeah. Okay. Wow, that's all very interesting. Axel Merk of Merk Investments, thank you for joining the Contrarian Investor podcast today. A fascinating conversation. Maybe in closing, just tell our listeners how they can find out more about you, more about your firm, and I'll put all that information in the show notes as well.
Sure. merkinvestments.com is our website. I can't talk about our products here, but to go to our website, you can learn more about it. We have a newsletter there. You get my unfiltered views on Twitter at Axel Merk. I will tweet up a storm during press conferences by Powell or the ECB. Otherwise, I'll give my musings there, but that's really the best way to kind of follow me on interpretation of what's happening on a daily basis. Beyond that, we manage. By the way, we managed 1.6 billion as of December 31st last year. We're currently, as we're talking, at 2.3 billion. A lot of that is increase in valuations, and I'm not bragging about performance here. That's the gold market, right? We're in gold and gold mining. And the bragging about you can get if you look at the details on things, but it's simply a reflection of the environment we're in. That it's just the space is comparatively small, and so when that space gets moving, it can be quite significant. And for my compliance, so that they don't chop off my head, I have to say that that's not a prediction of how that will what will happen in the future.
Correct. And nothing we say is investment advice. Do your own research, make your own decisions, as I like to say. Merkinvestments.com, at Axel Merk on Twitter/X. Thank you to Axel. Thank you all for listening. And we look forward to speaking to you again next time.
Thank you for listening to the Contrarian Investor Podcast. We hope you enjoyed this episode. To subscribe to this podcast, simply open your favorite podcast software and search for Contrarian Investor. Follow us on social media by searching for Contrarian Investor on Twitter and Instagram. Send us your thoughts on feedback@contrarianpod.com. We look forward to speaking to you again next time.